Imagine you open your bank app and see $1,200, but you've just blown $800 on a new TV and a weekend getaway. That $400 left feels like a win, until you realize the $800 you splurged could have been the first seed of a future fortune. Paying yourself first means treating your own future like the most important bill each month. Instead of waiting until the paycheck is gone, you automatically move a set amount into a savings or investment account the moment the money lands. Most people do the opposite. They pay rent, groceries, a gym membership, then wonder if there's anything left for savings. That creates a habit of scarcity, not abundance. Take a realistic scenario. You earn $5,000 after tax each month. If you set aside 15%, that's $750 right away and invest it in a low-cost index fund earning 7% annually. After 10 years, you'll have about $112,000. If you wait until month-end and only manage to save $300, that same 10-year journey ends at roughly $45,000. The simple step: set up an automatic transfer the day your paycheck hits, even if it's just $200 to start. When you think about building wealth, the line between assets and liabilities becomes crystal clear. An asset puts money in your pocket. A liability takes money out. A common mistake is calling a fancy car or a bigger house an asset because it's valuable. In reality, those items depreciate and require ongoing costs: insurance, maintenance, property taxes. Consider two parallel lives. Person A buys a $30,000 used car, pays $2,000 a year for insurance, and spends $3,000 a year on gas and maintenance. That's $5,000 a year just to keep the car running. Person B buys a dividend-paying stock for $30,000 that yields 3% annually, netting $900 a year, and the stock appreciates 5% annually. After 10 years, Person A has spent $50,000 on the car, while Person B's investment has grown to roughly $53,000, plus $9,000 in dividends. The actionable tip: audit your biggest monthly outflows and ask, does this bring money back to me? If not, look for a cheaper alternative or a way to monetize it. A tiny pause can save you a lot of regret. The 24-hour rule says, before any purchase over $500, wait a full day. Most people think they know what they want instantly and click by the moment they see it. The brain's reward centers love that instant gratification, but they also love to rationalize it afterward. Picture this. You see a high-end blender for $600 and click Add to Cart. If you wait 24 hours, you might discover the same model goes on sale for $450, or you'll realize you already have a perfectly good blender. In numbers, imagine you buy that $600 blender outright. Over the next 5 years, you could have invested that $600 at a modest 6% return, ending up with about $800. That extra $200 is the cost of impulse. The habit to adopt: set a reminder on your phone that any purchase over $500 triggers a check tomorrow. Negotiating salary is another habit that separates the wealthy mindset from the average. Many accept the first number offered, assuming it's the market rate, and walk away with a lower lifetime earnings trajectory. The misunderstanding stems from thinking salary negotiation is aggressive or unfair. In truth, it's a normal part of professional life, and most employers expect a conversation. Let's say you land a job with a $70,000 starting salary. If you negotiate a 10% increase, you begin at $77,000. Over a 30-year career, assuming a 3% annual raise, that difference compounds to roughly $340,000 more in earnings. If you never negotiated, you stay at the lower baseline, missing out on that substantial sum. The concrete move: research industry salaries, list your achievements, practice a polite script, and ask for a 510% bump before signing. Relying on a single paycheck is a fragile strategy. Wealthy individuals often build multiple streams of income: rental properties, side businesses, dividends, freelance work, so that if one source falters, the others keep the colony thriving. The misconception is that a second job means more hustle, not more leverage. Imagine you earn $4,000 a month from your main job and nothing else. A sudden layoff would drop your cash flow to zero. Now picture adding a modest side hustle that nets $500 a month, plus a dividend portfolio that yields $200 a month. Even if you lose the primary job, you still have $700 to cover essentials while you regroup. Over a decade, those extra $700 monthly become $84,000 before taxes, plus any growth from reinvested earnings. The practical step: identify a skill you can monetize: writing, tutoring, graphic design, and allocate just 1 hour a week to start generating that extra income. Insurance is often misunderstood as a way to make money. The wealthy view it as protection, a safety net that preserves wealth when unexpected events occur. Some people think life insurance or whole life policies are investment vehicles, and they pay high premiums for minimal returns. Let's break down two scenarios. A family buys a $2,000 annual whole life policy that promises a cash value growing at 2% after fees. After 20 years, the cash value is about $48,000, but the total premiums paid total $40,000, netting a modest gain of $8,000. Conversely, a $2,000 term policy protects the family for 20 years with no cash value. If a tragedy occurs, the death benefit, say $250,000, provides a real financial cushion that could otherwise be lost. The actionable tip: decide whether you need protection, term, versus growth, investment, and choose the policy that matches that goal. Now let's talk about the silent giant, compound interest. It's the engine that turns small, consistent contributions into massive wealth, and equally, the monster that devours missed opportunities. Most people underestimate how much a decade of delay costs. Suppose you could start investing $5,000 this year in a diversified fund earning 8% annually. After 10 years, you'd have about $108,000. If you wait 10 years to invest that same $5,000, you'd only have $5,000 plus any tiny growth in the interim. Essentially nothing compared to the earlier scenario. The gap is over $100,000 purely from postponement. Even a 5-year delay shrinks the end value from $108,000 to roughly $73,000, a $35,000 loss. The habit to embed: treat each month you can save as a fuel tank for your future engine. Don't leave it empty. All these habits share a common thread: timing and intention. When you pay yourself first, you set the stage for compounding. When you buy assets, you let money work for you. The 24-hour rule gives you space to let reason beat impulse. Negotiating your salary gives you a higher base for all future growth. Multiple income streams diversify risk, like a colony spreading foragers across many trails. Smart insurance protects the nest, and compounding turns tiny seeds into towering trees. The ant colony doesn't wait for rain to fill its tunnels. It constantly reinforces walls, stores food, and sends scouts out for new sources. If you adopt any one of these habits today, you'll feel the first ripple of change. Start with the simplest. Set that automatic transfer to pay yourself first. Your future self will thank you, not with a sigh, but with a thriving bank balance that proves disciplined habits are the real wealth-building blueprint. Keep moving forward, one intentional step at a time.